What if a single regulatory decision could reshape the entire future of cryptocurrency, not just for one token, but for an industry worth more than $1 trillion? Imagine a world where the difference between security and non-security doesn't just impact investors, but determines which digital assets survive, which businesses thrive, and which innovations are strangled before they begin. Right now, deep inside the heart of the U.S. financial system, Ripple and the SEC are locked in a battle over the true identity of crypto, and the outcome could either ignite a new era of growth or trigger a chilling effect across the globe. Welcome to the front line of the crypto revolution, where digital assets are fighting for legal clarity and billions ride on how one question gets answered. When does a crypto asset like XRP finally stop being a security in the eyes of regulators? To understand just how explosive this moment is, let's rewind. For over a decade, cryptocurrencies have challenged the oldest institutions in finance. What started with Bitcoin as an experiment in peer-to-peer money has since evolved into a sprawling universe of tokens, decentralized applications, and blockchain-based economies. But as capital poured in and projects multiplied, so did the gaze of regulators determined to protect investors, or, as some see it, to reclaim control. The U.S. Securities and Exchange Commission, the SEC, has wielded one of the sharpest weapons in its arsenal, the so-called Howey test. Developed in a 1946 Supreme Court case, the Howey test set the standard for what qualifies as an investment contract, or in modern terms, a security. If an investment involves a common enterprise, expectations of profit driven by others' efforts, congratulations, it's probably a security. But crypto assets are complicated. Unlike stocks or bonds, most tokens don't come with ownership rights or company dividends. They aren't always sold in initial offerings. By the time tokens reach the public, they're often traded on secondary markets, shuffled between wallets around the world, detached from their origin story. So, when does a digital asset outgrow its initial classification? When is it no longer a security, and what would that change mean for users and companies? Enter Ripple, the company behind XRP, one of the world's largest cryptocurrencies. Ripple was designed to revolutionize cross-border payments, offering near-instant, low-cost transfers between banks and individuals. Its token, XRP, became one of the top digital assets by market capitalization, traded on exchanges worldwide. But in December 2020, the SEC dropped a bombshell. It sued Ripple, alleging that the company had sold unregistered securities by distributing XRP to investors. The news sent shockwaves through the market. Exchanges delisted XRP. Millions of holders were left in limbo, not knowing if their asset would soon be declared effectively illegal. But Ripple fought back. In the courtroom, Ripple's legal team sharpened its argument. XRP is not a security, at least not when traded by ordinary people on secondary markets. The case dragged on for years, its result awaited by every major crypto project, investor, and regulator. Then, July 2023. In a landmark ruling, Judge Annalisa Torres drew a sharp distinction. Yes, Ripple's early institutional sales of XRP had the characteristics of an investment contract. Think special deals with hedge funds or partners. But the token itself, when sold on the open market, was not a security. For the first time, the court recognized that a digital asset could shed its securities label, depending on how and where it was sold. This decision set the stage for a new kind of debate. If XRP is not a security in most hands, when exactly does a token become, or stop being, a security? And could this provide a template for future projects to follow, granting them clarity and legal safety? For months, the industry held its breath, waiting for more guidance. Investors grew wary. Crypto companies eyed other countries with friendlier rules. In Washington, pressure mounted for Congress to create new laws. Regulators circled, issuing warnings and fines. SEC Commissioner Hester Peirce, known as Crypto Mom, urged for a new paradigm, a modern approach that recognized the unique qualities of digital assets. She advocated for safe harbors, periods where projects could develop without the threat of immediate crackdown. But ambiguity persisted. Meanwhile, the SEC's crypto task force ramped up its efforts. FINRA, the body overseeing U.S. broker-dealers, flagged a worrisome trend. Crypto-related firms were failing to comply with disclosure and diligence obligations, leaving retail investors exposed and confused. As Senator Lummis urged an end to what she called regulatory enforcement actions, the industry found itself at a crossroads, caught between innovation and compliance, opportunity and risk. It was in this climate that Ripple made a bold new move. In late May 2025, after a high-stakes meeting with the SEC's crypto task force, Ripple submitted an additional letter to the commission, seeking an answer that could finally settle the debate. The letter cited the 2022 academic paper, The Ineluctable Modality of Securities Law, arguing that once tokens are sufficiently decentralized and traded on secondary markets, they should be treated like commodities or currencies, not securities. But here's where Ripple took a daring turn. Rather than relying on the notoriously fuzzy concept of decentralization, Ripple proposed a new, more concrete standard: maturity. Picture this. Instead of endless arguments over who controls a blockchain, the focus shifts to how resilient and independent the network really is. Ripple's proposal? Judge a token's status by three main indicators. Market capitalization. Has the asset achieved enough size and trading volume to indicate healthy, organic demand beyond the founder's reach? Operational history. Has the network been running long enough without major hiccups or interventions to prove its stability? Lack of unilateral control. Are there any parties left who can make sweeping decisions over the protocol or the marketplace, or has control dispersed among users and developers? The current law does not support classifying most fungible crypto assets as securities when traded on secondary markets, Ripple's letter insisted, quoting the Cohen paper. The company argued that ongoing disclosure requirements for these assets could actually be harmful, misleading the public into thinking affiliated parties still hold the reins, even when they don't. This is more than wonky legal theory. The stakes are enormous. If Ripple's maturity framework is accepted, hundreds of crypto projects could finally step out from the regulatory shadows. Exchanges might relist tokens. Investors could operate with clarity, not fear. On the other hand, if rejected, uncertainty will deepen, and U.S. crypto businesses may continue their exodus to friendlier shores. But not everyone is convinced. SEC Commissioner Caroline Crenshaw, for example, strongly dissented from a potential settlement with Ripple, arguing that it might undermine enforcement and harm investors. FINRA, watching crypto communications closely, warned that many firms still aren't transparent about risks and rules. Critics argue that the maturity standard is too vague or easily gamed, that big numbers or long histories don't always equal true independence. Regulatory inertia remains a formidable foe. Meanwhile, Congress flirts with new subcommittees on digital assets, but concrete legislation remains elusive. Policymakers are torn, move too fast, and risk legitimizing bad actors, move too slow, and lose the technological race to other jurisdictions. And so we arrive at a pivotal moment. Ripple has drawn its line in the sand, offering a new path. The SEC, battered by public pressure and mixed courtroom outcomes, must decide whether to build a new framework or double down on the old ways, all while billions hang in the balance. As the dust settles, one question looms larger than any other. Will the U.S. embrace Ripple's maturity model and give crypto a clear runway for growth, or will regulatory uncertainty continue to choke innovation and drive the next wave of talent and capital offshore? The next moves will not only decide the fate of Ripple and XRP, but could set the rules for every digital asset, every blockchain startup, and every investor trying to navigate this high-stakes financial frontier. As we look to the future, the implications of Ripple's latest move and the SEC's eventual response reach far beyond the price of one token or the fate of a single company. They touch at the very heart of the crypto industry's ability to operate, innovate, and grow within the United States. So what could happen next? Let's break down the major scenarios, the risks on the horizon, and the opportunities that might unfold, both for XRP holders and for the entire digital asset landscape. One possibility: the SEC seriously considers Ripple's proposal and moves toward a new era of pragmatic maturity-based regulation. That would mean, instead of labeling tokens like XRP as securities forever, tokens could eventually graduate once their network is sufficiently independent and active in the market. Imagine a future where new projects have a path to compliance, investors have real clarity, and U.S. exchanges don't live in constant fear of retroactive lawsuits. That's the bullish scenario, a green light for responsible innovation on American soil. But there's another, harsher road. The SEC could double down, rejecting Ripple's arguments and sticking with its current enforcement approach. The result? Prolonged litigation, ongoing legal ambiguity, and a chilling effect on crypto development within the U.S. We've seen this story play out before, with some of the world's brightest blockchain projects choosing to launch their tokens overseas or restricting American users outright. If the question of when a token ceases to be a security remains unresolved, The real losers could be American entrepreneurs, developers, and everyday investors left behind as innovation migrates abroad. Now Congress is watching too. With a Senate subcommittee on digital assets newly formed, there's growing political momentum to finally create a comprehensive crypto framework. As Commissioner Pierce has repeatedly argued, we need rules that recognize the unique properties of digital assets, rules that foster experimentation, while protecting the public from genuine fraud. If lawmakers step in, the gridlock could finally break, ushering in clarity for exchanges, developers, and token holders alike. But legislative action is notoriously slow and unpredictable. Will Congress act in time, or will regulatory uncertainty linger for years? And let's not overlook the role of other regulatory bodies. FINRA, for example, is raising alarms about compliance failures in the way crypto is marketed to retail investors. Their message: due diligence is non-negotiable. Broker-dealers and exchanges are on notice. No more Wild West, no more get-rich-quick promises without proper disclosure. If regulatory standards tighten across the board, it will force the industry to mature, but also weed out bad actors, setting a higher bar for participation. The global context matters too. The European Union is already rolling out its MiCA regulation, providing a single rulebook for crypto assets. Asian hubs like Singapore and Hong Kong are competing to be crypto capitals. In this environment, America risks losing its technological edge if it can't balance innovation with sensible oversight. For XRP itself, the stakes are enormous. If Ripple's arguments prevail and XRP is officially recognized as a non-security for secondary market trading, it could open the floodgates for relistings on major U.S. exchanges, Coinbase, Kraken, Gemini, and beyond. Liquidity would surge, interest would reignite, and the narrative could shift from regulatory risk to institutional opportunity. But as long as the uncertainty drags on, traders and investors are left watching from the sidelines, wary of sudden enforcement actions or delistings. In the words of crypto policy expert Miles Jennings from A16Z Crypto, for too long, the rules for digital assets have been a black box. Until that changes, the U.S. will keep ceding ground to more forward-thinking jurisdictions. So where does this leave you? The viewer, the trader, the builder, or perhaps just the curious observer? First, it's a powerful reminder. Regulation isn't just dry legalese. It directly shapes which tokens you can buy or sell, which exchanges you can access, and how safe your investments truly are. Today's courtroom dramas are tomorrow's market realities. If you're holding XRP or any US-listed crypto, keep your ear to the ground. Monitor official communications, not just from Ripple and the SEC, but also from the emerging Senate subcommittee and FINRA bulletins. Regulatory winds can change quickly, sometimes overnight. For entrepreneurs and developers, Ripple's maturity framework is both a warning and an opportunity. It signals that U.S. regulators are at least listening to industry proposals, but the final outcome remains uncertain. If you're launching a new project, build with compliance in mind from day one. Consider how your token's journey might evolve, from those risky early days to a matured, decentralized network. Don't ignore your operational history, your market cap milestones, or your governance structures. They might one day determine your regulatory standing. And for those on the sidelines, now is the time to get educated. Regulatory clarity is coming, eventually. Those who understand the difference between securities and non-securities, who can spot red flags in token offerings, who know the questions regulators are asking, these are the people who'll be ready to seize the next wave of opportunity. There's also a deeper takeaway. We're witnessing a turning point in the American approach to financial innovation. The crypto industry is maturing, regulators are catching up, and the voices of everyday investors and builders are finally being heard in Congress and the courts. This is how disruptive technology enters the mainstream, through legal battles, policy debates, and yes, a fair share of regulatory drama. Remember the words of Senator Cynthia Lummis, a champion for crypto in the U.S. Senate. The time for endless enforcement is over. America must lead in blockchain, not lag behind. Whether lawmakers agree remains to be seen, but the winds of change are blowing. So, will U.S. regulators embrace Ripple's new framework, or will the status quo persist? Based on everything we've seen, the answer is, the door is open, but the outcome is far from certain. Ripple's proposal has sparked real debate inside the SEC and on Capitol Hill. The Commission's crypto task force is actively seeking input, and influential voices like Hester Pierce are pushing for a smarter, more flexible approach. But powerful factions remain resistant, wary of moving too quickly or undermining their enforcement powers. And every day that passes without clarity, the pressure on the U.S. system increases. Here's a secret fact that hasn't made headlines. Some legal experts, speaking off the record, believe the SEC's enforcement streak is already softening. Quietly, the Commission is drafting new guidance for broker-dealers and opening back-channel talks with industry leaders. This could be the start of a new era where collaboration replaces confrontation. But no one's popping champagne until the ink is dry on new rules. So, what's next? Your voice matters. Join public comment periods. Support industry groups working for smart regulations. Demand clarity from your elected officials. It's not just Ripple's fight or the SEC's dilemma, it's the future of America's role in the global digital economy. If you found this deep dive valuable, hit the like button, subscribe for more expert crypto content, and share your take in the comments below. Should the SEC adopt Ripple's maturity standard, or is Congress the only way forward? Stay alert, stay informed,